Welcome back. In this episode, we are going to address the question, what are the keys to prudent investing or saving money? And there is a test that I use to determine the key elements of a prudent investment. You'll be shocked how many investments do not pass this test. And even real estate fails miserably the way most people own real estate. But it doesn't matter if your money's in the market, stock market, real estate market. This is a key factor to learn the key elements. So put on your seatbelt. Here we go. I'm Doug Andrew, and I developed this laser test years ago when I began to realize that most places where people put money to accumulate it for their retirement or any long-term goal did not pass this critical test. And I learned the hard way clear back in 1982 when I did not have my money into a position that passed this laser test. Now, you're going to learn here, and this is in a certain order for a reason. This is in order of importance, and most people make the mistake of not putting this in the right order. So the laser test spells LSRR, which is, I abbreviate it to liquid asset safely earning returns. In fact, my favorite vehicle I call the laser fund because it passes this test with flying colors. So number one would be liquidity. If you want to put your money aside, you want to make sure you can get to your money when you need it with an electronic funds transfer or phone call. That's liquidity. Number two on the list is safety. You want to have safety of the institution where your money is parked, but also safety of your principal, that when I set aside $500 a month, or 10,000 or a $500,000 or $1 million, I don't want to lose that principal. I want it protected. And any year that I make money, I want that to be locked in. I don't want to ever lose the money I've made in previous years in the future. Most advisors don't know how to do that. They just say, hey, you just got to roll with the punches. Some years you're going to make money and some years you're going to lose. Well, do you want to lose the money you made the previous 2 or 3 years? That's what happens all too often when your money's in the market. Number three would be to earn a predictable rate of return. Now, I mean predictably, not pie in the sky rates of return, but returns between 7, 8, 9, 10%, or if you watch some of our other episodes, you can actually use multipliers on indexing strategies, for example, and increase your rate of returns predictably to 9 to 14%. So you want a rate of return that historically has beaten inflation. So other episodes I talk about, you have to link your returns to the things that inflate so that inflation doesn't hurt you or hinder you, it helps you. I've always earned a rate of return of at least 5.5% greater than the inflation rate at the time, and you can learn that from some of the other episodes. And then down here is, I want tax-favored accumulation, not just tax-deferred. I prefer tax-free rather than tax-deferred because in a tax-deferred IRA or 401k, if I earn 12%, I'm only really netting 8% after having to pay tax at the end of the day when I take out the money in retirement. If I was wanting to earn a net of 10, I have to earn 15, pay tax of a third to net 10. I would just as soon more safely earn 10% tax-free, and I can do that in a safer environment than trying to earn 15%, which incurs more risk, to net 10 in a tax-deferred account. And then I like to have my cake and eat it too. So I like all of the above. So let's review the three key elements of a prudent investment. Are you ready? Liquidity is number one. Again, that is the ability to access your money when you need it, because when things are bad, you need access to money in a day or two at least within 24 hours. Most emergencies will let you have at least a day or two to access your money. So that's what I'm talking about with liquidity. A lot of times when you need the money the worst, it's the hardest to get if it's tied up in real estate. And people say, I have a ton of equity. Well, that means nothing but a number on a sheet of paper. If you cannot go get your equity by selling the property, and it takes sometimes months, sometimes it's a recession and you can't sell the property for what you thought it was worth, or you go try to refinance it after you lose your job, there's not a bank or mortgage company around that's going to loan you money if you don't have the ability to repay. They don't care how much equity you have or used to have. They loan you money based on your ability to repay. So you want to have liquidity, and that's why I keep all of my real estate equity separated into what I call my laser fund. So it doesn't matter if the real estate goes down in value, I don't lose, but I can go get my money because it's not tied up in the property. When we go to safety of principal, you want to have your money in institutions that are safe. I choose the multi-trillion-dollar life insurance industry because they have weathered periods like the Great Depression with flying colors, paying 2.5%, 3.5% when banks closed their doors and 40% never reopened their doors again, and some real estate dropped 80%. They went through the Great Depression crediting 3 and 4%. So during historical times like 2008, there were about 400 banks that went under. There were 900 more that were on the brink or the watch list. My money in the insurance contracts were continuing to earn predictable rates of return, and I didn't lose during that time period. And if I don't make money during certain years like 2008, in 2009, I locked in gains of 16% tax-free. And then the next year, if the market were to dive, I don't lose the 16% I locked in 2009. And this is called lock in and reset. So that's why I call it safety of principal. And anytime you make money, you want that to become newly protected principal. The third key element is earning predictable rates of return that historically has beaten inflation, because you cannot have your money in some low-yielding savings account at a bank earning 1%. That's like going 1 mile an hour, and the current of inflation is coming down at 3, 4, and 5. You're going backwards. So you want to have a competitive rate of return that historically has beaten inflation, or what I say is it's linked to the things that inflate. So if you've watched some of my other educational episodes, you may recognize this risk-return paradigm where I actually use these 3 key elements of a prudent investment: liquidity, safety, and rates of return, and I apply them to typical investments, all the way here ranked from the highest risk commodities clear down to the lowest risk, which people would say would be equity in your house. In my various educational books, and you're welcome to read some of them, I'll give you an opportunity to get a book absolutely free. You just cover shipping and handling. And I usually go through and I'll say, okay, let's apply the liquidity test. This many of these different places where people invest money do not pass the liquidity test. You can't get your money quick enough when you need it. It fails the liquidity test. And I learned that lesson the hard way with my house. When I was out of income for 9 months, I had a ton of equity in my house back in 1982, but it meant nothing. I could not access it, and I tried to sell the house, and I had to lower the price of the house. I couldn't go borrow because they're not going to loan me money if I don't have an income to make a mortgage payment. So I learned that lesson the hard way. I don't want you to make the same mistakes I've made. And so that's why I'm passionate. I let all my licenses go in 2005 to become a consumer advocate to help you. I want you to avoid the mistakes that I've made so that you don't have to take so long to achieve financial independence. So liquidity, many investments are not liquid when you need the money. When we apply the safety test, this many more fail the safety test. You are not earning that rate of return in a safe environment. You can lose principal in many of these investments. Just like people in the stock market lost 40% twice in the decade from 2000 to 2010. Sometimes people that have money in real estate, they saw their real estate dwindle in value. My house went down in value in 2008 to 2009 from $1.5 million to $1.1 million in one single year. The funny thing is my property taxes didn't go down, but the value of my house went down. So many of these things do not have safety of principal. Third would be rate of return. This many more fail the rate of return test. How do we do that? Well, you've got to be earning a rate of return that is at least equal to or greater than the inflation rate, or you're going backward. So if inflation's at 3, you need to be earning at least 3 or higher. What I like to do is position my serious money that I set aside to earn a rate of return at least 5 to 6% greater than the inflation rate at the time. Then I'm making headway. Who wants to just break even earning a rate of return equal to the inflation rate? So this many do not pass the rate of return test. It leaves us with 3 possibilities. 10 might be a small handful of mutual funds. I had over 3,000 clients in mutual funds back in 1974 to 1980, but they were never happier to get out of the volatility of the market and put them, when we put their money into number 12, max funded insurance, because from that point forward, they didn't lose when the market was down. Number 15 is an annuity. Annuities are offered by insurance companies. They're simply savings accounts with an insurance company. But the rate of return isn't all that great in the long run. Sometimes some annuities may guarantee you income to not outlive your money. But generally speaking, I can earn a greater rate of return in a max-funded insurance contract with the same insurance company than an annuity. And people go, huh? Doesn't life insurance have costs that annuities don't? You'd be surprised. Sometimes the same insurance company on an annuity quoting 7 or 8 or 9 or 10%, the insurance contract with the same company, indexed universal life, structured properly, outperforms the annuity by 2, 3, or 4 percentage points. And so I prefer this one, and the insurance comes along for the ride. It's not free, but I'm not paying for it. The cost of the insurance only drains out about 1 of my percentage points. If I'm earning 11, I'm netting 10. That's money that would otherwise go out the window in unnecessary income tax. So my favorite vehicle that passes liquidity, safety, and rate of return test with flying colors is this one, number 12, the max funded insurance contract. So that's why I've written several books about these. And so if this is intriguing you, my most recent book that explains this in depth is called The Laser Fund, and you can go to laserfund.com and get a copy of this, or watch this video and you'll understand this a little bit better. Then you'll be able to understand why you may want to dive deeper into understanding that, and you'll have an opportunity there to be able to get a free copy of the book sent to you.